Hello, our guest today is Peter Hewitt, manager of the CT Global Managed Portfolio Trust, which is an investment trust of investment trusts and comes in both income and growth versions. Peter, thank you very much for coming into our studio.
Yep.
Well, it's great to have you here. Can you please explain to me what the differences are between the growth and the income trusts and how you put together a portfolio of investment trusts?
There is, a growth portfolio and an income portfolio within the one trust. So they are separate. They do have one or two things kind of in common or that they kind of transfer, which I'll come on to explain later. But they are quite separate. The growth portfolio is focused on capital growth. It doesn't pay a dividend, so it's capital only, whereas the income portfolio does. It's got a yield of around about 5.5%, and it aims to give you the income, growing income, but also some capital growth as well. So hopefully, a decent total return is the objective. And in both cases, the benchmark's the all-share index, so that gives you kind of a bit of a guide as to how we're measured.
How are the different portfolios managed and how many investment trusts are you investing in?
Right, well, both are about 40 stocks. Actually, at the moment, I think growth is 41 and income 39 or something. I'm afraid to say there's no real science behind that. It's just that that's about as many as I can, keep tabs on and meet and visit and analyse. I also think I don't want to own sort of 100. I think that becomes, you start proliferating lots of trusts and very small positions at the bottom of the portfolio. Similarly, I don't want just sort of 8 or 10 trusts. I think that could be, too much concentration. So I think 40, if you think about it, that should be each portfolio size should be about 2.5%. It's not. Some of the top 10 are up at 4 or 5%. Some of the smaller ones at kind of 1.5, but I've got none at really small holdings. So 40 in each, roughly.
And how do you pick investment trusts? You've been doing this for a long time. What are the tricks of the trade?
Well, to be honest, there's no real tricks of the trade. I mean, a lot of it is just graft. And so, for example, in all the investment companies I've got holdings in, I pay quite a lot of attention to the annual report and the interim report. Also, fact sheets or commentaries that managers may put out. But, the annual report is important. It carries a lot of useful information, both from the chairman and the manager. And you'll get the whole portfolio. You can also look at the balance sheet, if it's geared, what's the nature of the debt, the duration, the cost, fees, how are they charged, how are they allocated, what's the revenue reserve, could be important for dividend orientated trusts, and a host of other things. So that is something that anybody could do. I obviously spend quite a bit of time doing that. One of the kind of key advantages of being what you might say an institutional investor in trusts is I do get access to the fund manager. I try and meet them all face to face once a year, sometimes more often if there's important things going on. So for example, yesterday I saw the manager of Temple Bar, which is a UK equity income trust that I took a shareholding in back in February when I first met the manager then. So that was a kind of top-up meeting. A lot has changed in the UK equity market since then. Has their portfolio changed? What's their views, etc. And from that, and when you do a lot of manager meetings, you can actually kind of glean some important information. Obviously, what's the investment style? I mean, are they changing it? Have there been big changes in the portfolio? There's a whole series of questions that you can ask that are quite useful and help me come to a conclusion. Should I still be holding it? Should I be considering selling it? Or if it's a trust I don't hold shares in, is it one that we potentially should? So that's the sort of stuff that that's your day job, really.
And do you pay much attention to a trust discount? So this is where you can buy a portfolio for less than its net asset value. Is that something that you think is maybe an attractive entry point if you see a large discount open up?
Yes, it is, and it is an important factor to look at with trusts. But it's one of the important factors, Sam. It's not the most important. By far the most important is how will the assets perform over the longer term. And if you can kind of form a view of that, that's what really generates the performance. A discount, I mean, I like to buy a good trust with, an experienced fund manager investing in an interesting area at a discount. But if the discount is just narrow, or maybe it's trading at par, that is about its asset value, that won't put me off buying it. If I feel the asset story and the individual fund manager is going to generate some interesting returns. So a discount or a premium are a factor, but it's not the dominant factor.
And did you spot any opportunities regarding discounts this year? Trust discounts have widened a lot. Did you see any opportunity to pounce and pick up shares that you've always wanted to get your hands on?
Well, yes. I mean, I have, for choice, really now for most of this year, I've been actually a buyer of UK trusts. I think, I kind of have try and build a bit of a framework of my thoughts on markets, inflation, interest rate, bond yields, all of that. I'm part of the multi-asset team at Columbia Threadneedle, and they have big macro meetings. So, how attractive is Japan, America, whatever. And the UK stock market is valued quite attractively just now. In fact, really, since the Brexit referendum in 2016, it's been derating against most other markets. And that's now got to quite an extreme stage. So there's some good value there. And I have been gradually picking up UK trusts over this year. Those orientated more towards FTSE 100 have done quite well. Those with a mid and small cap bias have not done as well because the mid cap index is down about 25%, as is the NASDAQ in America and many European stock markets as well. The FTSE 100, I think, is flat to slightly down, and that's courtesy of, I'm going to say 12 or 15, maybe 20 mega cap companies that everybody knows and loves: BP, Shell, some of the banks, pharmaceuticals, and they've actually performed quite well for differing reasons. And so that the index looks like it's doing okay, but actually the rest of the UK market, and to be honest with you, the economy, not been doing that well. But that's been the area I've been kind of gradually building up.
And which trusts have you been buying to access those big UK stocks?
Well, in the growth portfolio, I've been buying Fidelity Special Values, which I think is an interesting sort of all-cap fund. It's performed quite well. Been adding to Law Debenture and Lowland. They are two holdings that I have in growth and income. They've both got good dividend yields, which are rising, but I think they've got some quite good capital upside as well. Others in the growth portfolio I've been buying have been Aurora, Henderson Opportunities, and one or two other UK trusts. In the income portfolio, I've been adding to City of London. I've bought holdings in Temple Bar and also Merchants Trust. And that's been funded by kind of some overseas trusts I've been lightening up on. So that's been, and I would say it's partially worked, but that's been the area I've been adding to this year so far.
Are there any trusts that you've held for a very long time in the portfolio that you like to own regardless of the macroeconomic conditions, and you just love the manager and the asset class perhaps?
Yes is the answer, and I think this comes on to quite an important point that I want to make. Yes, we listed in April 2008, and there's a number of trusts I bought in the first week that actually I still hold, and a lot of them I actually didn't buy or sell for a very long time. And these tend to be ones that are focused on what I would call secular growth opportunities. So typically a technology trust, Scottish Mortgage, best known, some of the healthcare trusts as well. And I think over the long run, they will deliver some really interesting returns, and they have done. In the past year, they have been not so good. And, you know, Scottish Mortgage is down 50% from its peak, really, since last autumn, I would say. And that's due to a change in market circumstances. So what have I done? I've actually kind of top sliced a third, a half of these positions. So I still hold all of these trusts, Allianz Technology, Biotech Growth, Polar Cap Technology, just they're further down the portfolio. And Sam, I wanted to say, I mean, in the case of Scottish Mortgage, which is the best known trust, and it's down a lot this year, Scottish Mortgage is roughly 7 times the book cost in the portfolio. Now, okay, that's over 14 years. It had a fantastic kind of decade. But these types of trusts, I think, are the trusts to hold on to for the long term. You will make many times your original investment. Whereas with some of the more value-orientated vehicles, you're just never going to get that type of return. They can perform well, maybe for a year or 2 years, but they're not invested in long-term growth companies. So it's just worthwhile. From a fund management viewpoint, it's important for me not to say goodbye to these trusts because they're run by good managers and they've got great long-term prospects.
Peter, thank you very much for coming in.
Thank you.
And that's all we have time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.